Okay, everybody, welcome, welcome. We're going to let everyone filter into the webinar before we get started, but you are in the right place. We're just going to take a minute for everyone to kind of get in. But you guys are in the right place. Welcome to the Back to Basics webinar. We'll go ahead and get started. Hello, everyone, and welcome to our webinar, Back to Basics, Pension and OPEB. We are happy to have you with us here today. Before I introduce our presenter, a few housekeeping items. This webinar is being recorded, so be on the lookout later today for an email containing a link to the recording, as well as a copy of the slides and other resources. This webinar will run for 50 minutes with a 10-minute Q&A immediately following. If you have any questions for our speaker, please put them in the Q&A box located in the Zoom toolbar. To find that, hover your mouse over the top or the bottom of your screen, and a toolbar will pop up. This webinar is eligible for 1 hour of CPE credit. We will launch 4 polls throughout the presentation. To receive credit, you must answer 3 out of the 4 polling questions, and also complete the short evaluation you will receive afterwards. LSL is using a new system, so please note that the evaluation email will be coming from LC Vista, and please allow up to 1 week to receive this email. If you're having trouble seeing those polls, try minimizing the Zoom screen, as sometimes the poll question box pops up behind it. Now I'd like to introduce our presenter. Riley Greenlee is a senior manager in LSL's Assurance and Advisory Department, where he specializes in auditing government agencies in accordance with government auditing standards and the Single Audit Act under uniform guidance. He is skilled in planning the nature, timing, and extent of audit procedures to ensure compliance and efficiency. Riley holds an advanced single audit certificate from the AICPA and serves as a technical reviewer for GFOA. He is passionate about helping government entities earn and maintain the GFOA Certificate of Achievement for Excellence in Financial Reporting. Whether he's guiding clients through audit or helping them improve their financial reporting, Riley is dedicated to strengthening the transparency and accountability of local government entities. Okay, Riley, take it away.
It's quite the intro. Thank you, Cami. I appreciate it a lot. I'm excited to be here again this year and go through the same subject together, talking about pension plans and OPEB plans, the basics. It's funny, I think back to GASB 68 and 75. I aged myself a little bit here, but I think 75 was the first year I started auditing when that came in. It's been about a decade now. So excited to kind of jump into this. So kind of starting off, go through our outline for today. We're going to get started with your getting started, kind of talk about the basics of pension and OPEB plans. We'll talk about the different types of plans, the importance of the different dates in the backing data and kind of how that structures your approach for preparing journal entries or footnotes or whatever that might be. Which brings me into, the next topic, which we'll actually talk about recording GASB 68, 75 journal entries. We'll look at the difference between, recording an entry for an agent plan or like an OPEB plan versus cost sharing plans. Kind of from there, have that all complete and jump into that preparation for the audit phase. Look at, what your auditors are going to request, some of the things that they're going to look for. So really the goal at the end of today with that part is you're going to leave here with a list of items to say, yes, I've got my checklist. I know what I'm going to have to send to my auditor ahead of time. And I'm going to honestly look like a superstar because I'm going to be ready and ticked and tied out and all good to go. Then we'll kind of close out the session just with some common mistakes, tips and tricks, things that we've kind of seen across the industry, questions, decade later with these GASBs that we still do get, or mistakes that we still do see, and kind of go from there. All right, so we're going to kick off with that getting started phase. And with that kickoff, we're going to kick off our first polling question as well. So curious about what kind of pension plans that everybody here has. Do you have an agent multiple, single employer plan? Do you have cost sharing? Maybe you have both. Maybe you have multiple plans, and C applies to you. And then D, maybe you don't know. And that's why you're here today. And that's awesome as well. So we're going to walk through kind of the ways to identify different plans and how to know what your organization has. There we go. Okay, so starting off, we want to get ready for everything. So we need to know, what reports do you need? What kind of plans does your organization have? So we need to determine, how many pension plans you have. Some organizations are going to have more than one. You might have a miscellaneous plan. You might have a miscellaneous plan. Do you have an OPEB plan? What are the details of that? And then within those pension plans and OPEB plans, are they cost sharing plans? Are they agent plans? Are they single employer or multiple employer? These do cause differences in, the way entries are going to be performed. Kind of the underlying data you're going to gather, how those valuation reports are going to look, and then even your footnotes in your financial statement, there's going to be differences. So the structure differences between these, for example, I think the biggest change you'll see, or the biggest difference you'll see, is kind of between that agent plan versus cost sharing plan. So a little background on those. Agent plans are essentially plans where the asset and all underlying liability information is segregated just for your organization. So you could be part of a multiple employer situation where you do pool plans for investment purposes, but separate accounts are always maintained. You can go in at any point and say, hey, these share of assets that's sitting in this account, they're legally available to pay out the benefits of only your employees, and you always have access to that. Cost sharing plan, on the other side of it, multiple employer, you're going to be in a pool. So think of like CalPERS pool plan. Everything's going together for investment purposes, but there isn't that segregated account. Those assets sit in that pool and can be used really to pay anybody's benefits out. And that's how they function. And that's going to be kind of changing how you disclose some of that in your footnotes. With the agent plan, you're going to be focused more on what the plan is. It's going to kind of reflect a little bit more of the schedules and charts that you see in your valuation report versus a cost sharing plan, which is going to talk about your portion of the pool as a whole. Quick note, cost sharing plans, generally these are for organizations that have less than 100 active members at any time. CalPERS does have requirements, though, that if you fall below 100 active members, you will automatically be moved, if you're an agent plan, to a cost sharing plan. And the caveat of that is once you're in a cost sharing plan, you cannot move back into an agent plan. So you can see situations where maybe one year you have 110 active members, and we go through a few years, you lose some employees, and you're down to 95, and you are transferred that cost sharing. Even if you came back up and had 150 active members later, you still won't move into that agent multiple. Oh, we got some poll results here. So it looks like a pretty good spin here. 21%, is there really a difference? We can definitely talk about that. And hopefully by the end of this, you'll have that answered. But nice to see that we have a good mix of people who have just agent, people who have just cost sharing, and people who have both. Okay. So listed just a couple other examples. I mentioned CalPERS, but we do have other plan providers as well. So there's also SB Sarah and OSERS as two prominent ones down in Southern California. It tends to be more focused on location. So SB Sarah is San Bernardino County, OSERS Orange County. So then a lot of times where you are depends on where your reports are coming from. So checking to see who your provider is ahead of time can be very helpful, and who your point of contact is. So regardless of what plan you have, whether you're coming from one provider or another, the same rings true. You need to request those reports. You need to get those valuation reports out early. Oftentimes they can take time to come back. Have seen them delay audits in the past. Specifically, I'd say OPEB plans can delay a lot. because those do take a little more effort on your side versus something like CalPERS, where it's going to be a more automated process. They're working through many actuarial reports every single year. And then the cost sharing stuff is automatic. They get their own audit and publish all those allocations, and that stuff gets publicly posted for everybody. So kind of the next step, once you know what type of plan you have, is to look at the dates. And I think every year, whether it's from a client of mine, or I'm at some CSMFO event or even a new auditor, people get confused with the dates and what they mean, and they ask questions about it. So let's clear that up. I thought it'd be a good idea. We'll dedicate a whole slide just to talk about the dates. So whether we're talking about GASB 68 with pension plans, or we're talking about GASB 75 with OPEB plans, the dates are the same, the requirements are the same, and there's really just three that we need to be aware of. The first one's the easiest. It's the reporting date. Simply, this is your financial date. Whatever your ACFR date is going to be, so for most probably in this webinar, it's going to be June 30th, 2025. That's your reporting date. This should be on your actuary report that your actuary is ultimately using to value your liability. The second one, this is where we get into the more difficult dates, is valuation date. So the valuation date is what the actuary uses, essentially to value your plan. It's that underlying data that they're going to take, what employees you have that are active, inactive, what type of benefits that they're receiving, any assets that you have at that time, and they're going to use that to calculate the liability. And we'll talk about the next date in a second, but measure that one forward for reporting. Per the GASB 68 and 75 standards, this date is flexible. Their one requirement is that it has to fall within 30 months and 1 day of your reporting date. So you're probably going to use a year-end date like June 30th. So effectively, they can be about 2 years behind, which does give you advantage. You can, in quote, roll this date, meaning you could use the valuation date 2 years in a row. I probably see this most common with OPEB plans because you do have more control over those valuation dates versus like CalPERS, where they are going to run a new one every year and they take control of that. Some of the advantages of rolling a valuation date is it can save time. It's quicker for them to measure forward and roll a valuation when they've already looked at the underlying data. It can also be cheaper as well. So it's probably the two most common reasons I see people do that. Just note, I mentioned CalPERS, they take more control over this. They, and I believe SB Sarah and OSERS are the same. They always roll their dates every single year. So CalPERS has a standard, it's 2 years behind. So for the 2025 year end, it's going to be June 30, 2023. And they change it every single year. Our final date is the measurement date. And now the measurement date, this is actually the date at which they determine we're going to take fair value factors, we're going to take all contributions that have been made to the plan, and we're going to use that to measure, what that net pension liability, what that net OPEB liability, what are the value of the fiduciary net position at that point. Under GASB 68 and 75, this date is a little stricter. They basically, when you had to implement this plan about 10 years ago, you had to choose a date and a setback. So most people picked about a year behind. So this year, most people will probably be June 30th, 2024. And the caveat is that cannot change based in relevance to your reporting. So if you chose 1 year behind 10 years ago, you're always going to be 1 year behind. Now, there were some organizations that chose the same year as their reporting date. I don't know why. That sounds like extra work, but unfortunately, if that is your case, you're stuck with that. You can't change it. And it also means that in relation to reporting and the valuation date, that those can be same at the same time as well. So if you say roll a valuation date forward, you might have a 2-year setback on your valuation this year, 1 year on your measurement, and then your reporting. The next year, you might do measurement and valuation date the same to roll up to your reporting date, and it's all a year behind, which would then allow you to roll it forward the following year. So I know I'm talking a lot about identifying this date, what these dates are, identify what type of plan you are. But I thought it important to add some examples of, okay, I know what I want to find, but how do I find it? So here's a couple examples that I kind of pulled out that we can take a look at. So here is a CalPERS actuarial report. It's for the city of LSL, but this is their first page, and all the CalPERS reports look identical to this, and they write out in the first page, give you the type of plan. So they're saying this is a miscellaneous plan, and it's an agent multiple employer defined benefit pension plan. They also are nice enough to give us the measurement date on the front page, so we know right out the gate, measurement date this year is June 30, 2023. Scroll down just a couple pages in that report. They have their intro section, and they're going to detail out the rest of the dates for us as well. So here in this report, we can see the valuation date is June 30, 2022, and measurement date agrees to that first page, 23. And they're even giving us the measurement period just to remind us that walk forward with the measurement from 22 to 23, essentially. Another report that you might see, this is the allocation report. So this is part of cost sharing plans with CalPERS, but they also publish data for the types of plans that you have. You can see your agency actually listed on here if you're part of the cost sharing pool. So it could be another area to kind of gather some of that information. But if you don't have access to those reports, if you don't have access to like your evaluation report at the time, or maybe you're new to your organization, you had some turnover and you're trying to catch up with what's been done in the past. Let's remember, these are 10-year-old GASBs. So your footnotes, this is an excerpt from a city's ACFR here. Your footnotes will have this information disclosed. As long as you're not a brand new organization preparing financials for the first time or setting it up, most of you are going to have access to the information. This is the first paragraph where it's going to denote. In this case, this city is saying that they participate in a few different plans. This is their pension footnote. They have a cost sharing plan that's a safety plan just for their police and their fire employees. And they have a miscellaneous plan for everybody else, and that is an agent multiple. So if you're ever in doubt on the information, go back to your footnotes. Those will have been audited in the past and are going to have at least some starting information for you as well. All right, so once we've kind of determined our plans, our dates, whether you've gotten that from an actuarial report, whether you looked at your footnotes, or you're just a seasoned veteran here and you know what your organization already has, we do have some other next steps for what we kind of need to gather. The first thing being contribution data. So we should know what contributions have been made to each plan for the year. That's going to be important, especially if the measurement date is behind a year. So for most of you, that's going to be the case. If you have CalPERS, they actually have in their My CalPERS login, you can run a report. It's called the Billing and Payment Summary, I believe. And that kind of details out what they have in their records for reports. But you're certainly welcome, run your payroll reports as well and see if you can isolate what you've contributed during the year. If you have questions about the My CalPERS stuff as well and running that, we've worked with a lot of these systems. CalPERS has a business access thing too that gives us read-only access. We can certainly help you run those or show you how to do it. The other thing you're going to want to have is prior year valuation reports, as well as your journal entry. That's going to give you kind of your starting point to where your numbers begin to get to where you need to be. It might also be a template for how your organization has historically prepared these entries. That kind of underlying data is very helpful. It's not absolutely necessary, but especially with like cost sharing plans, it can save you a lot of extra time and effort. And then the last thing, this isn't applicable for everyone, but if you do have allocations for your plan, so say you give shares of your pension plan to your water fund, for example, and then maybe to like an internal service fund, you'll want to have those calculated and ready to go for both this year and the prior year amounts. So it might already be in your prior year journal entry schedules, great, but you'll need to know what the prior stuff was so that you make sure you're booking to the new amounts correctly. Another allocation thing I think people forget sometimes is our functional allocation. So for your government-wide statements, knowing what needs to allocate to general government versus public safety, public works, or whatever. So real quick, we can do polling question number 2. Just gauging the crowd, how long that people have been working. About 10 years was a low marker, but if you're over 10 years, then you are definitely a veteran of the crew. All right, so we've gathered everything. We know our types of reports. We know our dates. We've got our contribution stuff. We got our prior year entries, our prior year valuation reports. We're feeling confident. Now we got to book these entries. So booking these entries, starting with agent plans. These ones will be a little bit more straightforward because they're going to be plans in which you get all the ending information basically provided to you. I believe even cost sharing plans with SB Sarah are this way as well, where you get your final number broken out according to your organization. So you'll see a table like this in your actuarial report, kind of breaks out all the different changes for the measurement period. You got your total and pension liability, you got your fiduciary net position, and then your net pension, bottom right corner of this table. That's what needs to be on your ACFR. Similarly, this is included in that same actuary report. They're giving you a breakdown of the deferred outflows and the deferred inflows. So we know at the end of the day that 1.3 billion is going to be what needs to be in deferred outflows on your ACFR, and that 39 million is what needs to be kind of a deferred inflow here. I've gotten this question a couple times, so just addressing it here, our deferred inflows are negative. The reason they do that is because deferred inflow is a credit on your balance sheet. Some actuaries do it, some don't. But for your footnote purposes and your reporting purposes, you don't have to report it as negative. That can just be a positive number, as long as it's delineated in this fashion so you can see it's an inflow. The other note here I wanted to make, I purposely chose a valuation report where there was no contributions subsequent to the measurement date. Not every actuary is going to give you that information. And that's important because any contributions that happen after your measurement date that up until the reporting date need to be deferred. And so that has to be included in your calculation. And in this case, will not tie directly to your ACFR. Nope. And let's see, polling question 2. A lot of experience. We got some new people and a lot of people 5+, most of us. Okay, cool. Okay. So I think that's important. So let's jump right into that. Those deferred outflows for contributions. So this is the part I think that people do forget to run first, but we need to know what's been paid out. So like I said, your measurement date might not be the same as your reporting date. And the measurement date, as we remember, is they're taking into account all the fair value stuff, and they're taking into account any contributions that are made to the plan. So if you have a measurement date of say June 30th, 2024, and we're reporting for the 25 ACT for this year, you've got a whole year of contributions that you've recognized. that's not being reflected in the net pension liability. And because that's not being reflected, we need to take that out of expenses and we need to defer that for a future period. And again, the places you can start pulling this from is your payroll records to see what's been run there, or you can use something like that CalPERS billing summary form, whatever it is to get that information so that you can defer it, because that's going to be important in our first couple journal entries. So let's do an example. Here is breakdown of 3 entries that we're going to record, whether it's an agent pension plan, whether it's an OPEB plan or a cost sharing plan, it still follows this same structure. So the first 2 entries you'll notice right off the rip only relate to deferred outflows for those contributions that were subsequent to the measurement date. So if you're one of the people that your reporting date and your measurement date is the same, this doesn't apply to you because you have nothing subsequent to measurement date. So while it is more work to get everything ready and you don't have the 1-year buffer, you do get a benefit, I guess, in this realm where you only have to book one part of GASB 6875 and not the other 2 first journal entries. I think most people here, though, that's not going to be the case. So you're going to have to book these first 2 entries. So the first one is we're going to look at last year. We're going to look at what did we record and what did we defer for contributions in the prior year. And let's take that off because we need to take that out of the deferral and we need to recognize that now. So we're going to put that against the net pension liability, which takes us into journal entry 2. This is going to be the new stuff. So this is that new recording of setting up the deferred outflow and taking that out of expenses because we don't want to recognize those now. We'll recognize those in a future period. And then journal entry 3, this is like the meat and potatoes entry where you're going to true up all the other amounts. You're going to make sure your net pension liability, your deferred inflows, and then the outflows with the contributions all tie back to what the actuarial amounts are that are reported. So the example I kind of put together, so we looked at a valuation report, we're going to say, and we have this agent multiple plan. And we've determined that based on that report, we have a net pension liability. It's $1 million. Our deferred outflows per the report are 100,000. The report did not include subsequent contributions. So we ran a payroll report and we know that we contributed $10,000. And then the ending deferred inflows on that actuarial report were 50. And then we went and looked and said, okay, well, who has employees that are paying into these pension plans and who gets a share of this pension plan? We determined that governmental funds are taking about 75% of it, water funds about 15%, and then we have a fleet fund that's internal service that gets about 10%. So you can break out the change however you want. This is one of the templates that we use that we're comparing what was the prior year balance, in this case 23, for the net pension, deferred outflow, inflow, and then those contributions, and then what 24's new amount is. And then the breakout from there based on the allocation for each of those, government-wide water fleet funds and what the final number should be. So in this case, we're seeing that the net pension liability overall increased by about $250,000. Outflows went up by 25,000, inflows by 25,000. Last year, we had deferred contributions of $5,000. And as we saw on the last slide, this year's contributions are $10,000. We'll do this entry at the top level, but whether it's top level or you're booking it for one of the individuals, it's the same. It's just the allocated percentage that you're going to book. So this is what our entry is going to look like. So journal entry 1, we talked about, we're going to be getting rid of that old prior year contribution number, right? So in this case, we had from our chart, $5,000 was prior year. That's what we contributed. So we want to debit the net pension liability. So we want to recognize that that's part of that pension liability now. And then we want to remove it from the deferred amount. So that 5,000 needs to come off. And then we're basically doing the reverse. We're going to set up now $10,000. That's what we contributed this year. That's subsequent to our measurement date. And then we want to pull that out of the pension expense accounts because we don't want to expense it this year. That's deferred. And journal number 3 now is our true up. Like I said, our meat and potatoes, we want to make sure everything in the end agrees. So deferred outflows, we noted increased by 25,000. So we want to debit deferred outflows, increase that. Our net pension liability increased by 250,000. So we're doing 245 here because we already changed the net pension liability by $5,000 in the first entry. And then we're going to do deferred inflows increasing by 25 as well. And then our plug for the entry is going to be our pension expense. So for full accrual funds, you can simply just hit a pension expense account. If it's governmental funds, if we're doing this at the government-wide level, we'll want to break that out by the different functional expenses. Miscellaneous might be an allocation amongst all of them. Maybe it's a safety plan just for your police and fire employees, so you just want to hit the public safety function. So something to consider when you're looking at these entries and breaking them up. Then real briefly, I just want to throw this out for your reference. You should all have copies of this slides too after the webinar. It's the same entry if I'm doing it for just one of the individual funds and we're doing the actual allocation. So we have the breakdown just for fleet. The only thing I would say keep in mind here is remember that with the allocation, you're trying to book to final numbers. You're not booking percentage change. So if you take the changes and you multiply that by the allocation, that may work if your allocation doesn't change. In this case, fleet does change from 5 to 10%. So fleet at the end of the day, the net pension liability should be that 100,000. It should be 10% of the current liability. And if you do it on change, you won't get that amount. So those are agent plans. Those are OPEB plans. The amounts are given directly to you. Cost sharing plans, the entry is the same, but there's a little more back-end work potentially depending on the type that you have. Looks like I have one question here. We'll stop on this. Question is, how were the fund level allocations developed and what are they based on? Allocations are typically developed on the cost, like the pension expense that those funds are contributing during the year. So you could use that as a reference point. You could use the number of employees and total cost as well. Whatever you do use there. I mean, if we're going to help a client with our with the allocation, like we're going to help them prepare the entry, I typically run like a payroll expense detail, look at your GL accounts and come up with an allocation based on that by what funds are contributing. So that's a good question. Okay. All right, so cost sharing. There could be some extra work involved with these. So with cost sharing plans, there isn't that separate account. So whether your plan provider is doing the calculation for you or you have to do the calculation, that's the first thing you have to determine. I'll say right now, if you have a CalPERS plan, you're out of luck. You have to do that calculation yourself. I believe SB Sarah and OSERS do it for you. So in that case, you get your numbers, book it just like an agent plan. For the CalPERS plan, this is that allocation report that we looked at the beginning of the webinar, and it's going to give a percentage factor. So you can see we have two columns here. We have a column for the total pension liability employer allocation factor, and then we have one for that fiduciary net position. They're going to list your agency. You're going to pull up both of those numbers so you know what share you get from the liability and what share you get from the fiduciary net position. Those will be different numbers. So the way you calculate this, whether you have a template for yourself or somebody's giving you a template or you're building one, it's the same. I'm going to use LSL's template that we share with our clients, and we use to test your cost sharing plans as well. So there's a lot of information here, and I don't want that to take away from what we're trying to accomplish, because at the end of the day, it's straightforward. You'll see the orange highlights here. That's going to be all the information from the whole pooled valuation report. So that's everything. That's everybody included in there. And then up in the yellow boxes, that's where we import the dependent organizations like allocation. So that runs through here. That's going to pull through and kind of generate to these footnotes and calculate what your liability is specifically for your organization, what your deferred outflows are, what your inflows are as well, so that you can prepare the entry just like an agent entry would be at the end. One of the important notes I will call out here, some of these inflow outflow items, they're based on layers. So we talked about at the beginning of this, you're going to want your prior year journal entry as well. You will use those old layers that get allocated over the years and update from your prior entries so that they're properly incorporated in this calculation. There's a little more work on the back end involved with that. Fortunately, we don't have time to go through it in this webinar, but I would reach out if you're having struggles with those, reach out to your auditor. You can reach out to LSL. I'm happy to answer questions about those types of things or figure out what the numbers you need. There's a nuance to it. But once you get them, once you get a good template that you like, keep it and use it every year. So everything kind of pulls through and updates on our first page. So this is still our template. And the first thing you're going to notice is it's pretty similar, if you look on the left side there, to the prior agent entries that we talked about. I keep reiterating, the entry does not change. It's just the way you calculate it. So you'll see still we're doing the deferred contributions, both the prior year and the current year. And then we actually have columns that break out for each individual allocation. So here you can see government-wide, what the current year allocation was, about 80%. And then our prior year allocation, it was like 82%. We also break out right in here as well, those functional allocations that I talked about. So you can see the percentages and put in those yellow boxes. Just scrolling down, same page. Here's journal entry 3. Again, a lot of information here. There's a requirement that we have to calculate all these individual deferred amounts separately, but it's the same. At the end of the day, you have your ending prior year amounts in the first table, your ending current year amounts, and the change. So it's just building that journal entry to get us those final numbers that we want them to be. And then in our template, it breaks out again on the right there. That's the government wide. You'll see, I think our example, we have the water fund and that fleet service fund as well. You'll see a column for each one of those. But I think the biggest takeaway for the cost sharing plans is it can seem daunting because you get all these allocations, you have to do all these calculations yourself. But if you remember at the end of the day that, hey, we just need to get the final numbers and we need to book to those final numbers, then you should be okay and have some check figures in place. So it kind of wraps up the preparation stage, what you're going to gather, how you're going to prepare a report, GASB 6875. And so you're kind of ready for your ACFR at year end. But now let's talk about kind of audit preparation, which auditors are going to need. And that list we talked about that you can basically hand over to them and say, here, we're ready. Here you go, audit it. And we're good. Before we do, quickly, we'll do poll question number 3. So I'm just curious, who prepares your entries? So do you prepare them in-house? Do you have your auditors help you with that? Maybe you find a third party and consultants help you. Or maybe it's magic and they just prepare themselves one day, or maybe you're a tech guru and you figured out how to make AI do it. I don't know. If anybody figured that out, reach out to me. I'd love to hear how you did it. All right. So kind of some of the items that your auditors need. What are they going to ask for? Well, the first thing I'll say is the convenient part of this is you had to prepare this stuff. We have to verify it. There's going to be a lot of overlap here. It's the same things that you already used. So we're going to determine what types of plans you have, and we're going to ask for all of your valuation reports. Every pension plan, your OPEB plan, we're going to double check that the plans reflect what we expect them to be. The dates are what we expect them to be. Going back to that GASB 68 and 75 rule, is your valuation date within 30 months and 1 day? Is your measurement date rolled forward another year and consistently applied? Usually your actuarial will help you with that, but we're going to double check. We're going to probably ask for like your fiduciary net position reports or like audited financial statements. Like if you have a trust for your OPEB, we might ask for statements for that trust so that we can, verify the amount that's offsetting your liability. A lot of that information too can be publicly available, especially with CalPERS. They publish a lot of that information already for us, but it never hurts to put that on your list and collect it for your package that you give your auditors. At the end of the day, it's important to remember that whether stuff's available publicly for us to pull or not, your financials, they're your responsibility. These entries are your responsibility. So take ownership, go through the list, collect these things, because double checking that your stuff ties at the end of the day and you have all the information you need at the end of the day, protects you and sets you up for a successful audit, because you'd much rather catch something than have us, go through pull items and we catch it, right? Kind of the last piece that we will need is all the rest of that supporting data. So like your journal entry, any payroll reports you ran for like contribution reports. We'll need the census data, that was the underlying data for that plan. Remember, census data is your valuation date. That's who you're covering, what their benefits are exactly. We need all of that so that we can reperform what you calculated. And perfect timing for pull 3 to come back. 62% prepare in-house. I love to see that. I'm also curious about 4% that prepare themselves by magic. So those 12 people, you're gonna have to reach out to me and tell me how you do that. All right, so why do your auditors need this? Well, the simple explanation is under auditing standards, we have to gain assurance over those, because in the end, we need reasonable assurance on your financial statements so that we can write our opinion. So kind of the first thing that we're going to do when we show up to audit is we're going to start tying those actuarial reports we talked about to the financial statements. Before I do anything else, if I don't see that ending liability amount doesn't agree to what's on your balance sheet, if your deferred inflows and outflows don't agree to what you have on your valuation report, something is wrong. We're going to have a conversation, figure out where we need to go from there. Once I get through that, then I'm going to start reviewing the journal entries, make sure that your allocations seem reasonable, make sure you're booking those entries properly and properly accounting for, say, like subsequent contributions, or the reports you had for those contributions make sense. Maybe your allocation percentages, say maybe 90% of the errors I see probably revolve around the allocation percentages, whether they're, unfairly allocated or there's an error in your journal entry because you decided to use the change percentage rather than the actual amount that needs to be at the end of the day. Again, put check figures in on your templates, put check figures in on your journal entries before you send this stuff over to your auditor. It's really easy to make sure that amounts agree before sending it over and having us find it and say, okay, well, hang on, something's off here. So I just got a couple examples, real easy to see it. Here's a snip at the top. This is from a different actuarial report that I pulled. So we know that the net pension liability in this case should be 14.9 million. So step one on work paper one for me with pension is I'll make sure that screenshot below, there's your balance sheet, maybe it's your GL. I'll make sure that ties to that 14.9. And then I'm gonna do the same thing for the deferred outflows and the deferred inflows. Make sure that the 6.3 agrees, make sure that 1.1 agrees. Really important note, you'll notice a difference here. I purposely did this again to make sure the two are different. You'll see the last line on deferred outflows does include the pension contributions subsequent to the measurement date. So this actuary, they had this information available. They included, and that's going to tie dollar for dollar to your balance sheet. If they don't, which a lot of the CalPERS reports do not, remember, those will not tie. There'll be a reconciliation. There'll be deferred contribution that we ran plus the deferred outflows on the actuary report. The same thing rings true if you've got multiple plans. This is a really simplified version. If you've got one plan going into that, say you have two plans, I'm gonna do the same thing. I'm gonna pull both actuarial reports. I'm gonna look at net pension liability on both of those, add them together, and make sure that that's what's being shown on the balance sheet. All right, so last part of this, why do the auditors need it? So this is the underlying testing that we're going to work on. So anytime you have a new valuation date, remember valuation date is that underlying data that's being valued. It's the census data, the list of employees who are active, inactive, all the benefits and how that's calculated. Anytime you have a new one, we have to audit the changes on that new one. If you get a new auditor sometimes too, and this is the first year of the contract, they're going to audit potentially all of the plan to develop a good basis too. So something to keep in mind. If there isn't a new valuation date, we don't necessarily need to test the census, but we might test contributions for the year and pull like current year data just to look at what's being communicated to the plan provider. So listing just a few common items that we request. We have to request those items that go into what's determining benefits for an employee. So we'll look at like new hires and terminations, kind of like that change. We might pull personal action forms, maybe HR files. We need to verify like things like date of birth, date of hire, gender, years of service, their pay rate, all of those things that kind of get packed into that census data. And then, like I mentioned before, contributions is more current year information and what's being communicated in like contribution reports every month to your plan operator. Make sure that that stuff's being, communicated to your plan provider correctly. So common mistakes we'll jump into, but the last thing I just wanted to reiterate with the auditor testing is, again, we're going back and we're looking at the stuff you've already prepared. So just reiterating the importance of having good templates goes a long way. Having check figures so you can check all this stuff and get all the wrinkles, ironed out before it goes to your auditor. These things, this list of items, it may differ from auditor to auditor. Not everybody's going to do it exactly the same way, but in general, when you're looking at auditing standards, I think this is a pretty good list of what has to be looked at. All right, so last polling question, and then we'll go into common mistakes, tips and tricks. How confident are you? I hope, everybody's a yes. But if you're a B or a C, that's totally okay. Feel free to reach out. I'm super happy to answer more questions after the webinar. If you've got a specific situation that's unique to your organization, I'm happy to discuss that as well. But yeah, your own auditor be available too. There's a benefit. A lot of firms are offering support now these days. These are, again, 10-year-old GASBs. So people have the experience. We have a lot of different cases and situations that we've encountered over the years. All right, so common mistakes. So the first one is reiterating what I said before. Actuarial reports don't agree to your journal entry or don't agree to your financial statements or your GL. Make sure that those agree before you turn them in. That's the easiest check that you can do. Just put that check figure right at the bottom of your journal entry. Make sure that at the end of the day, you're accomplishing what you're trying to accomplish. We briefly talked about the second one, allocation amongst your funds is incorrect, or like that prior year allocation being changed wasn't taken into account. Again, this is like that common 90% of the ones that I see where the template maybe was not used correctly or the amounts weren't updated. And so in the end, it was off. And usually where you're going to catch that mistake is by doing mistake number one, making sure your actuarial report agrees to your journal entry. Footnote information, lacking current information. So footnotes have to be updated every year. You know, there is information that goes over, like it will roll over year to year, but that shouldn't be just assumed. Look at your valuation report, look at your planned financial statements, and make sure all that information is updated to the new underlying factors. You know, discount rate is properly updated, inflation rate. You know, there's a plethora of data that gets published that these actuaries use to determine the value of these liabilities. And that needs to be disclosed in your footnotes. The dates, again, just remembering valuation date, measurement date. Typically, valuation is 2 years behind, revolves around that underlying data. Measurement date is typically 1, but that's the one that always has to stay the same setback from your reporting date. So hopefully everybody here on that one is locked down and solid on that one. And then a more recent one I've seen is missing short-term portion of unfunded OPEB liabilities. So I've seen some GFOA comments about this one that have been surfacing lately. And so people ask me, like, I don't understand. When do I have to do this? So the short answer is go to your prior year ACFR right now, look at your OPEB liability. If it says total OPEB liability, you need to consider for a short-term portion. If it says net, you do not. So the concern is if you don't have like a trust or some kind of funding behind, like say your OPEB plan, then there's an unfunded portion. So you need to set up that short-term current portion of that liability. Estimate for that should probably be what you expect, like your estimated contributions for the next 12 months. That's what we're using when we're preparing financial statements for our clients. But that's one that I've seen missed quite a few times. Some other tips and tricks. My CalPERS business access. I know I briefly mentioned this one, but this can be super helpful if you're a CalPERS plan. You can set this up with a form to your auditors, and it gives us view-only access where we can run reports. We can look up underlying census information. You know, it saves time on your staff. You know, your jobs don't stop just because the audit is happening, but the audit is a big, you know, project that you want to get done. So let's be efficient. If you're comfortable sharing that information, do it. I will say that it is a process. You have to fill out a form and submit it, and it takes 3 to 5 business days usually to process and give access to the auditor. So I wouldn't wait until like Monday of the audit to do this. You can find the form in the My CalPERS login. If you can't, you know, we have it saved as well. We can show you guys where it is or send it to you. Just reach out. Your auditors might have it too, you know, if you're not an LSL client. Consultants. I know, you know, in our industry, there's a lot of pride in our work. I definitely feel that, but we have a shortage in accountants. That's just the reality with a lot of retirements happening right now. So sometimes having a firm come in that has the experience and the staffing to knock these out can be helpful, can save you time, can save you money, might even be cheaper than having a salaried employee. Templates, reiterating again, templates are important. Statement of procedures, SOPs. I've never met somebody that regretted doing that. It helps with turnover. Like I said, we have a lot of retirements right now. New person comes in, they've got a clear SOP to follow. Awesome. You don't need to train them now to figure that out. I've seen so many horror stories where you have this great employee who's done it for years, they retire, and you're trying to figure out, okay, this template is it's very specific and I don't understand how it works. So these kind of things can be very, very helpful. Cross-training staff, things like that. And that kind of goes into the other tip with the allocation and having that template so you can track those percentages year to year. Real briefly, I know we're running down, we got 5 minutes left here, and I want to leave time for questions just in case. But I did throw in just with GASB 101, I have received a few questions about this. So GASB 101 is compensated absences. It's effective for all fiscal years beginning after December 15th, 2023. So for most people on this call, that's this June 30th, 2025 fiscal year. And it focuses on leave. And I've received this question around conversion. So if your organization has the option to convert like unused sick time, like say you don't pay out sick time, but it gets converted into credits for like your pension plan, those are excluded from what we've seen so far from GASB 101 calculations. You don't need to keep that as part of it. 68 and 75, those GASBs are already issued. They have their own valuation stuff. So think that stuff is just separate from everything else. For the rest of 101, I'd love to sit and talk about it. I hope, we've had some other webinars. I hope you've attended. If so, if you haven't, start that conversation sooner rather than later so that you can get that implemented for this year. All right. That's pretty much what I have. The next back to basics webinar in this awesome series that we're putting on is going to be accounts receivable. It's going to be Thursday, July 31st, 10 a.m. again. And we have the wonderful Vincent Parisi and Chloe Zabrick that are going to present on that. So I'm pretty excited to see what they have to say. And you can sign up and register in the follow-up email you'll receive after this webinar. It takes about 24 hours for things to go through sometimes, so just be patient when you get the invites and all of that. But I think it's going to be a really good one in our next installment here. And with a few minutes left here, I'd be happy to answer any questions that people have. Let's check the Q&A. Let's see. Richard Bear says, we received short-term OPEB comment from the GFOA last year. Yes, quite a few people actually did receive that comment. So I know a lot of people were scrambling and saying, what is this? We have to report a short-term portion now. So yeah, the GFOA has started leaving that one. So if you have a total OPEB liability, like you don't have a trust or something, start having that conversation if you guys need to determine booking that short-term portion. Roxanne, my ACFR shows net OPEB liability on the statement. And you don't have, yeah, so if you have a net OPEB liability, Roxanne, on your statement, here, answer live. If you have a net OPEB liability on your statement, that means that you have an underlying fiduciary net position. So in general, you don't need to record a short-term portion. Looks like it looks like Richard said that they were actually able to get their actuary to report the short term, I'm assuming this year. That's great. I mean, if they can estimate out what that is for you, then that gives you a basis to record it. For the most part, the recommendation is look at what your expected contributions are in the next 12 months, and that's kind of what you can estimate for your required expenses that should be short term for OPEB. Yeah, correct. Okay, cool. Thank you, Richard. That's a great point. I hope more of them actually break that out for everybody. It creates less confusion and you have something to show GFOA and say, yes, yeah, we're good. See. Sick leave as in compensated absences. If the amounts goes towards pension retirement credit, should we still include in the current portion of sick leave? So now you're getting into GASB 101 questions with me here. I would encourage you to reach out for GASB 101 questions and we can look at your specific situation. But yeah, in general, 101 is focused on what's going to be paid out. So if you have sick leave that could be converted, You still have to take into account what is probable for that employee to use to recognize in the liability. All right, we are at 11. I don't see any other questions here, but it was a pleasure speaking to everybody here. Great questions at the end. If you have more questions, feel free to reach out. Happy to have a conversation about like your unique situation. Otherwise, I hope everybody has a wonderful rest of their week, and thank you again for attending.
Awesome. Thank you, Riley.